In this chapter, we're going to take a deeper dive into accounts receivable and look at some other features of this account. First of all, we're going to go into accounts receivable, which we have a review of, a note receivable, the difference between those two, and then we're going to talk a little bit about other receivables, such as a trade receivable or these other receivables. So make sure you go through, really define what each of these mean to you so that you'll understand the differences. And just as a review, let's go through some of those journal entries regarding the sale and receivables. Since we're only really focusing on accounts receivable in this chapter, we're only going to look at that portion of the journal entry. For example, when you record a sale, you're going to debit that account receivable and you're going to credit that sales revenue. Again, we're not looking at the cost portion of those journal entries for this chapter. And it costs $5,000. The recording of the return, again, this should all be a review to you. Remember, we use an account called Sales, Returns, and Allowances. That's that contra account to your sales revenue, and then we're going to go ahead and credit that account receivable. And then when they go ahead and make the payment, remember there's those terms that we learned about. The 2 is the % discount if you pay within 10 days, otherwise it's due within 30. So when we record that payment, we're going to get cash, but since they're paying within the discount period, we're going to also debit that sales discount and then clear out the account receivable. I have an extra line in here. But you're only going to get that discount on the amount of account receivable that you still owe. So here, we debited that $5,000, but we're crediting the $500 return, so our current balance is only $4,500. That's the amount that's going to get paid off. Now, there's a discount involved. It's 2%, but that 2% is off of that $4,500. So that's $90, and therefore the cash we are receiving should be $4,410. Now there's a couple different terms we need to know regarding valuing this accounts receivable, because remember, not everyone is going to pay us. We just have to deal with that fact. So review some of these methods: that direct write-off method, which just writes off the account as an expense; the allowance method, which follows that matching principle. It matches your sales with the expense that some people aren't going to pay, and we recognize that in that same period. That cash realizable value of your accounts receivable is looking at how much you're actually going to get. We'll look at some percentages of accounts receivable basis and the aging of accounts receivable, as well as factoring, which means you can sell your accounts receivable. Some people do this if they need cash quickly. You sell it to somebody else and they collect it. The new account we're going to talk about is the allowance for doubtful accounts. This is the account that we set up for those people under the allowance method that we think aren't going to pay. Therefore, we can follow that matching principle under GAAP and recognize the expense in the same period that we recognize the sale. So this account, this allowance for doubtful accounts, is a contra asset account. It will attach itself to the account receivable. assets normally have a debit balance, but since this is a contra account, it will have a credit balance. And it'll show up with the accounts receivable on the balance sheet. So let's look at these two different methods of valuing your accounts receivable. The first one is a direct write-off method. It does not follow GAAP, so you're going to have to use this if your accounts receivable is very minimal to your financial statements. So how is it done? We wait until we realize someone's not going to pay us. We're going to then expense the account. When is it done? When we realize it's not collectible. And when we do realize the account is not collectible, we're going to expense that account. We use an account called bad debt expense. We'll debit that, and we'll credit the account receivable. The problem with this is it might take a year or two to figure out that this person isn't going to pay us. So this expense is coming in a different time period than that sale actually happened, which is why most people use this allowance method. The allowance method estimates how much is not going to be collected. It's done at year end, so it follows that matching principle. It matches, all the sales that happen in the year with an estimate of how much is not going to get collected. So at the end of the year, we're going to debit that bad debt expense, and we're going to credit that account allowance for doubtful accounts. Remember, that's that contra account to the account receivable. So then when you finally realize this account receivable is not going to get paid, then we already have this account set up and ready for that. So we'll debit that allowance for doubtful accounts. And we'll credit that account receivable, getting rid of it. So hopefully that's not too difficult to understand. Depending on what method they use, they're going to give you a percentage or tell you how much is not going to be collected, and that's the amount that we're going to write off. As I said before, we can also sell our accounts receivable. Maybe we need some quick cash. There's always a fee to that, so we are willing to take less cash than what the accounts receivable is actually worth because we need that cash right away. And we charge that difference to the service charge expense. And we're going to credit that account receivable and get it off our books. Same thing with the credit card sale. Again, we're going to debit the cash because as a credit card, the Visa, MasterCard, your normal credit cards, we're going to get that cash immediately. It's a quick wire transfer. But that credit card company is charging us a fee to do this. They're not charging the people paying or buying the merchandise. They're charging the store you bought it from. So that service charge expense goes in there, and then we're going to credit our sales revenue. Now let's look at taking a note receivable. Sometimes if, an account isn't going to get paid, we realize we can take a note. A note has a specific due date. We can charge interest, and then it might be more likely that you're going to receive that money with the due date and something signed saying that this person's going to pay. So the maker is the person who's going to be signing the note. They're the one who owes the money. Whereas the payee is the person who is getting paid. We have to calculate interest on this. You take that annual percentage rate they give you. You're going to multiply that by the time and the principal of the note. And honoring the note, this just means that you're going to make a payment or pay it off. So make sure you go through, read that section, understand those terms. And I just want to walk you through some of the maturity dates because this isn't meant to be hard, but a lot of people can't get this for some reason because it is a little tricky with the due dates. So the maturity date of a note, you need to be able to count how many days are in a month, and you don't count the day it was issued. For example, if a note was issued on July 1st, you're counting July 2nd through the 31st, which is 30 days. This is a 90-day note we're looking for. So in August, there's 31 days. So we have 61 total so far, which means we need 29 more days left. So in September, this would be due on the 29th. Interest, same thing. Make sure we understand that. If it's a 5% interest rate, a 90-day note, we're taking the principal times the rate times the time. And note that the time, if in days, is multiplied by the 360, not 365. So in a situation where an account receivable had not gotten paid, and we're trying to be nice, so we set up this note payable with the due date, with some interest. We're going to debit that note payable or note receivable, and credit that account receivable. This sets up that note receivable and eliminates that account receivable. And then when we go ahead and make that payment on September 29th, we will receive cash. Notice that the cash amount is for both the principal and the interest that's due. We will then credit that note receivable for the amount we set it up for, therefore eliminating that note receivable on the books. That will be gone. And then we'll recognize our interest revenue. You notice the interest revenue is for the amount that we calculated up here. That's it for this chapter. Please let me know if you have any questions.